guys, and welcome back to my channel. On today's video, I'm going to tell you a little bit about the lending process when it comes to buying manufactured homes. Now, there's a lot of fear mongering that happens around the lending process when buying manufactured homes, but let me tell you what my experience was, and then down in the comment section, I want you to tell me what your experience was like, because I'm sure that we probably had some different types of experiences, really depending on who we were dealing with in terms of lending. Being a realtor in the state of Florida, as well as having bought several properties, including a couple of pieces of raw land, including a new construction home, including 2 manufactured homes, and also including a previously site-built home, I can tell you that buying a manufactured home was no more complicated than buying the site-built home. If you're going to go through the process of buying a manufactured home, there's not only one option. There are many options. You can get FHA loans, just depending on whether the home was on an existing piece of property or not. You can go through 21st mortgage. There's also Vanderbilt mortgage. Or you can reach out to your local bank or credit union. And another place that we have financed land before was through a place called Farm Credit. So I don't know if these are just in my area. Farm Credit specializes in doing loans in more rural areas, as their name suggests, for farms. We also bought raw land through them. Some of the locations will do USDA loans. Some of them will do land and home finance together. And some of them will just do straight financing of the manufactured home so that you can put on your private land, which is highly recommended, to put your manufactured home on your private land, and that way you are building equity in your property. Back to the financing. What I was going to do was a no-brainer. I was going to 21st Mortgage. This is all they do. I didn't want to go to a bank and then they put me through a very, very long process, a strenuous process, because they didn't understand what to do with these situations. And in some cases, you may be able to get a little bit of a lower interest rate by going through your bank or your credit union, if they even do manufactured home loans. I didn't want to go through the headache and the unknowns of them trying to figure out the process. I wanted to go directly through someone who does this all the time. That's all they do. They do this full time. They know the process, and they can really streamline the process for you so that you're not having the headache going through with a lender who is not really familiar with the process. One of the important things to know is that your interest rate on a manufactured home is going to be a little bit higher, simply because it's considered more risk versus lending for a traditional site-built home. That's just a given. That is the society we live in. You're going to pay more for the interest. But if you keep your credit in good standing, then you won't pay nearly as high as someone who has not been protecting their credit. Does that sound familiar? Sounds just like buying a site-built home. When you're dealing with the people who do this all the time, it's pretty much the same process. I've done this on raw land, new construction, previously built, and manufactured. I know someone who recently bought a manufactured home. They only had 1 year of work, and they graduated from college back about 4 years ago. They were able to click the button that I was a recent college graduate, and the lender accepted that in lieu of having 2 solid years of work history. The closing process for me was roughly 15 days from the time that I decided on the home that I wanted. So let's go ahead and call that a myth buster to a lot of videos that I've heard to say that the manufactured home process closing takes a lot of time. It may take longer if you're using a lender who is not familiar with the process. So I would say do your comparison. They were more than willing to compare interest rates. And I wasn't so concerned about the interest rate anyway, because I have a little thing that I do, which is pay extra towards the mortgage. That saves me a lot more in the long run. And so what I did was I ran the numbers, because I know some people were going to be like, oh no, you can't pay a higher interest rate because you're mortgage payment is going to be so much higher. And so I ran the numbers. What you're looking at here is an amortization calculator from this website that I love playing around with called calculator.net. And as you can see, I put in the numbers: $100,000, 25 years at a 7% interest rate. And we'll go ahead and hit calculate and see what the payment it's going to give us. And so monthly it's $706.78 with a 7% interest rate. And as you can see, it'll give you a breakdown, and I just hit monthly schedule. It'll give you a breakdown of how much interest and principal that you're paying for each month, and then what your ending balance will be. It will show you all the way from year 1 to year 125. That's what an amortization schedule does. So let's go back up, and we're going to make an optional, check the box to make an optional extra payment. And we're going to use the number of $50, an extra $50 per month, and we'll hit calculate. And then it'll show you that instead of 25 years, your loan will be paid off in 21 years and 2 months, and you'll save $20,352 in interest. So that's if you pay an extra $50 per month. So now let's go ahead and change that interest rate to 8% instead of 7. And then we're going to remove that $50 extra payment, because first I want to see how much the payment would be from $706.78 if you add 8% versus 7% interest. Hit calculate again. And as you can see, you'll be paying, instead of the number that we just saw, 706, you'll be paying 771. So that interest rate increases the amount. And so we're going to include a $50 per month extra payment just to see how much it's going to take off of the years that you're paying on it. And as you can see, now you would be paying 20 years and 11 months, and you'll be saving $25,350 in interest. So that's a lot of interest that you're saving if you just make the extra $50 per month. And you can make however much you want. It really doesn't matter. And so now we're going to make 9%. And then from $771.82, let's see what payment that we get now. Got to remove that extra $50. So with a 9% interest rate, then you would be paying $839.20. That's your principal and interest payment. All right. And so if we go back and we add that extra $50 per month, then let's calculate, and that would reduce your payment by another couple of months. So 20 years and 9 months. And look at the interest though. It's increasing the amount of interest that you will be saving on that loan. Anytime I've had a mortgage, I'm going to always pay something extra towards that principal. I don't care how small the amount is. At one point when money got really tight, I could only pay about $5.38 per month. And as things got a little better, I started paying $10 per month. Then as things got a little better, $30, and then $50 per month. You'll start to see a significant savings in the amount that you're paying to interest. Let me know if you've heard of that online calculator before. If you try that, let me know just how much you can save off of the life of your loan from paying all of that interest if you were to make an extra $50 per month. If you made it to this point in the video, drop me a pink heart and a comment in the comment section below, and I'll know you made it. Thanks for watching. I hope this was helpful. Please share the video, like and subscribe with the notification bell on so that you'll know each time I upload a video. Thanks for watching, and I'll see you guys on the next video.